Hi, my name's Scott Barnard. I'm a portfolio manager on the multi-asset team at Westwood Group. We wanted to give a quick update on August performance. In general, August was another risk-on month. We started the month with some weak labor market data. This initially sent risk assets lower, but then throughout the month they rallied. Looking at performance, the S&P 500 was up just about 2%. The real outperformer in August were small cap stocks. So if we look at the Russell 2000, that was up 7% in August, bringing the year-to-date return now positive to 6%. The real driver for the small cap performance was the shifts in the interest rate curve. So interest rates moved lower on average, driven by the front end. If we look at the 2-year yield, declined from 3.96 to 3.62%, while the 30-year yield actually ticked up a little bit higher, going from 4.9 to 4.93%. Now, the reason this helps small cap stocks so much is that in general, small caps borrow on the front end of the yield curve, meaning they have a lot of more floating rate loans that they take out. So as front end rates go down, that helps the small cap stocks as it reduces their borrowing costs. Turning to fixed income markets, they also posted positive returns. The driver here was this move lower in interest rates. The aggregate index was up about 1.2%, treasuries up 1.06, investment grade up 1.01, and high yield up 1.25. So not a lot of divergence amongst the fixed income assets, but in general, they were all up. Corporate bond spreads were mixed in the month. Investment grade spreads were modestly wider, going from 76 to 79 basis points, while high yield spreads on average were a little bit tighter, going from 281 to 272 basis points. Looking at detail within the equity sectors, you can see in general, most sectors posted positive returns. A few outperformers such as healthcare and materials. Materials really benefited from the move higher in commodity prices such as gold. The healthcare sector had been a big laggard this year. It still remains one of the worst performers on the year, but has made up some of that underperformance. Financials were another beneficiary, as the steeper yield curve generally helps financials who borrow short and lend long. Turning to fixed income detail, we can see that in general there wasn't a lot of divergence amongst the fixed income performance. As we touched on in the first slide, most of the sectors were up roughly 1%. The one notable underperformer is the 25 plus year sector. As we showed, treasury yields were a little bit higher on the long end, and this impacted performance on the longer end of the corporate curve as well. Looking at spread performance by sector, not a lot of notable divergences here either. In general, things were 1 to 3 basis points wider. If we look at corporate spreads on a longer term basis, they remain near all-time tights. One of the reasons they have been able to remain so tight is that treasury yields have been elevated. So as we are now starting to see treasury yields move lower, we think there is a risk for corporate spreads to widen as that all-in yield becomes lower and some of the yield-based buyers begin to step away from the market. And now turning to outlook. This is our capital markets outlook that we update monthly. Our baseline expectation is that we're entering a period of sub-trend economic growth, and the Federal Reserve is likely to resume the cutting that started last year and then that's been on pause for about 9 months or so. The reason that we expect the Fed to begin cutting again is that the labor market does appear to be deteriorating. The Fed, as we know, has a dual mandate. They focus on the labor market, they focus on inflation. Inflation has been running a little bit higher than the Fed would like, but we think that the deteriorating labor market currently has the Fed's attention. We expect that they will begin to cut rates again in the middle of September, and then likely have another 1 to 2 cuts throughout the rest of 2025. There are some upside and downside risks as we look ahead, likely driven by the Fed being either more or less aggressive than the market's currently pricing in. Now turning to asset class outlooks. Equity market, we have a neutral outlook on. Earnings growth continues to come in relatively strong. The credit market, as we touched on earlier, spreads are very tight, and as yields continue to come down, we think that we could see spreads start to widen out. Interest rates, we think we are going to continue to see the curve steepen as 2 to 5 year yields drop, and 10-year and longer yields remain relatively range-bound or even move higher. Lastly, turning to the chart of the month. This chart shows the 30-year yield minus the 5-year yield, which shows how steep the US Treasury curve is. Generally, in the past, we've seen a steepening yield curve coincide with recessionary periods. It's possible that this time is different as the Fed is cutting rates now because of near-term inflation declines as opposed to near-term growth concerns. This is obviously something to keep a close eye on, but generally we don't think that this is steepening because of near-term recession concerns. Thank you very much. Once again, my name is Scott Barnard, Portfolio Manager here at Westwood Group, and thank you for spending some time with me recapping the August markets.